Good morning, ladies and gentlemen, and a very happy new year to you all. I hope sincerely that will be prosperous for all of us. And we start with a very, very high score. I mean, I cannot underline how positive a score 89 is. There is nothing perfect in this world, and 89 is as close to perfection as you can get and expect to ever see. Now we have new closes for the weekly and the monthly model as well, and they are both trending upwards. The daily model hasn't changed score for weeks, and the weekly model is now trending up quite decidedly as well, and the monthly one especially. If we have a look at the monthly new highs, and in this box you will see the moving averages following rapidly on its heels. That is, to me, as positive as it gets, and I think that this bull market in which equities outperform bonds has several more months to run. If we look at deviations, which you really should download every day and look at, there is not a single one which is anywhere near the red. The trend, the center line, is confirming the upward trend, and there isn't really a single sector, if you scroll through them, which is anywhere near the red or that is turning its middle line to a bear trend. Everything is, I mean, Utes, as you would expect, are going to be stable, because if the high risk is outperforming the bonds, that is what you would expect from the utilities. But every other sector, which is a risk-on sector, is in trend and nowhere near even giving the slightest bit of concern. There is nothing that I'm worried about in this market. I think all dips are going to get bought. Something fundamental needs to come out for you to be even slightly worried about your long positions in risk. I will examine certain narratives now once I've gone through what's happened in the past week, and very little has. So I'll run through that very quickly, and I'll examine some narratives that are out there that are trying to scare you out of your position, and explain to you why that is not going to happen anytime soon, if it happens at all. The bond market did absolutely nothing last week. You know, we are within 1 basis point of where we started the week. So the bond market was on holiday, and it really didn't care about anything at all. Now we do have a potential development on next week, which is the elections in Georgia, which might flip the Senate. I've been following the betting, the Las Vegas odds on that, and everyone is absolutely convinced that the Republicans will take both seats, and that the House will be, therefore the Congress will be split, and therefore that Biden is going to have great difficulty passing anything at all. Now, that is why the market really didn't move last week. If that narrative is incorrect, we will see a market steepening of the yield curve. That is, to me, without a doubt, and we will see this 140 level challenged. It is, if you see a headline come through that the Democrats win both seats, first thing you want to do is pick up the phone and sell bonds, or click your mouse, whatever it is that you do. So the yield curve will steepen a lot, and certainly the other thing that will happen is that the spread between Europe and the US will go out market. This chart shows you the spread 5/30s in the States and in Germany. As you can see, the spread between 5/30s has been absolutely steady around the 60 basis points forever. while the spread in the States has been steepening. And so you can see that that is the effect of the relative funding needs, and also the fact there are so few buxels out there that the Germans have issued that the Bundesbank just basically hoovers everything up that they can find. So this spread is naturally going out. Now, what you could consider is having this spread on in the early part of next week, if you think there is going to be a surprise in the Georgia elections, because if there is a surprise in the Georgia elections, this spread will remain quite fixed, while this one will go. So it's a low risk. I think that even nothing comes out, what can you possibly lose? 1 basis point, 2 basis points, but the trend is in your favor. So you might be 1 or 2 basis points underwater for a week, 2 weeks, but I think that time actually takes you out, gives you a profit in any case. So that is a very low risk, high reward way of playing the election if you are afraid that the Democrats might actually win against the odds. I don't think they will, but I will put some of this on because I think it's the risk to the downside is so low while the reward to the upside is so high. Now, nothing really happened in the dollar last week. You will have seen, some movement for year-end squaring, position squaring, and stuff like that. If you look at the weekly chart, it just, it means nothing. Even on the daily chart, what happened? Absolutely nothing. Some people got excited and, said, oh, this is the bottom for the dollar. I don't think it is. But if we do have a surprise in the Georgia election, I think that people will basically turn to risk off in a way. And by that I don't mean that they will be buying bonds, because I've told you, no, the first reaction and the biggest reaction is going to be a steeper yield curve. But what I mean is that since we are at 22 times earnings as it is in equities, you will, contrary to what some people think, that as a result of a Biden ability to pass more stimulus, you will have higher prices in the S&Ps. I don't think that's going to happen. I think at this point, multiples are far more important than earnings. And therefore, I don't think that the S&Ps, if they do spike up, there's going to be a great sell. But I think people will actually start buying dollars. I think people will take fright and start buying dollars, and we might go back up to 91.01. And if we bust that, we might actually start testing this line from the underside. That will be a great opportunity to actually sell dollars, but I think the reaction to a Democrat win on the Senate is going to buy dollars. I know that doesn't make any sense, but I think the relative differential in interest rates is going to make itself felt. And after the first panic reaction down in the dollar, the move is going to be up, and we are going to go most probably up to this 92.62 area. That is if the Democrats win. I don't think it will happen, but I just want to be open to all possibilities. Now, we have some very good triggers in the SPX. 37.25 being the first. You can see how we spent the whole week trying to break down below it, couldn't. So now that is very, very good support. These Bollinger Bands are very, very slowly on the 195 minute moving out. They squeezed the market as we knew they would, try to get the absolute best close and therefore revalue their positions and get paid. So I don't think the market is really up here. I think the market is probably 0.5% lower. The real market, they wanted to market up. They did. You know, so what? I think that basically we're going to remain in the range over the next few days, 2 or 3 days, between 37.25 and say 37.80, something like that, 37.90. The dailies don't really allow for that fast of an expansion. But should something happen to the elections, as I've mentioned, 37.25 is your key level. Starts breaking below there, there is air until 36.76. Okay, so that is going to be your first move. And if the real support, though, is 36.45, 46, okay, that is the real support. Starts breaking below there, something is very badly wrong. I don't expect it. That is going to be my level to buy calls. While if they spike the market higher on, you know, say the Democrats win and they go berserk saying, oh yes, we're going to get a lot more funding, we're going to get a lot more QE, we're going to get a lot more help for industry and stuff like that, I think that is all rubbish. Nothing of the sort is going to happen. Above there, that is the level I buy puts for a return to these levels. On the dailies, you can see it just as well. You can see how important 36.46 is. The lower Bollinger is there. That would mean taking out all these moving averages. You know, that is very significant. So anything below there and we start getting into some sort of panic mode. I don't know what the reason might be. But what I want to show you is really the fact that these, that it's unlikely that we move out of these Bollinger Bands that quickly, simply because it doesn't happen. Every time we go above the Bollinger Bands, we come below them, and we close above them. So it's going to take some time for us to do this kind of thing, hold this support, and if we hold it, then we will go. So I think the early part of next week, excuse me, is going to be very quiet. We're probably going to be hunting for stops. But if we do spike on the news that the Democrats have somehow won those 2 seats in Georgia, I think that is going to be a much better sell than buy. So little happened last week that really all I've done is updated some levels here in SPX and NQ as support and resistance. The weekly Bollinger Band doesn't come in till 38, 30, 40. But I don't expect that to be significant because the dailies are just not allowing for the expansion as I showed you. I think the early part of next week is going to be a grind. I think people will be hunting for stops on the downside and then they will be taking it up. I think net is going to be very little for the early part of next week. But here it is. I'll put the link on the tweet so you can download it and have a look at it. I think the only one that might be interesting is if gold busts this 1915 to 25 area, it's going to go to 1950 very quickly. You're going to get a $20-$25 move very quickly. But here I've put the first support around the 1860 area, and that is where I want to buy some if it falls. That's about that for this, and now I'll examine what the narratives out there are, and we will see together whether they're justified or not. Now, over the past weeks and months, I've seen a lot of people talking about these 3 factors. One, you know, they're speculating that inflation is coming. Secondly, that the stock markets are very complacent. And thirdly, that either the whole market or certain sectors, like say tech, are in a bubble. So let us examine the evidence for anything, whether here anything is true, and what that and what that tells us about the psychology of people in the market. Because if none of this is true, then we have a very, very long way to go to the upside as these people start chasing the market. But if any of this is true, then we probably have quite a bit of downside. So let us examine it objectively, see if any of it is true, and then we can understand what the psychology of the market for the next 3 to 6 months. So let us examine this inflation is coming. Now, the yield curve is one of the best predictors of inflation that I know of, and you will say, well, the curve in the States, the 530, is steepening. It is. But inflation is also a worldwide phenomenon, and the yield curve in Germany, if anything, is flattening, right? So how can that be? Well, to me, this is a sign of funding pressure, and that's it. So the differential can be explained via the enormous difference in funding pressure between one curve and the other, rather than the expectations of inflation. That is just one point. There are many other indicators, and let's look at all of them and see if any of them are flashing red. You would have thought that TLT against GLD, so the longer duration bonds over gold, would be an excellent indicator of inflation. And to be fair, this is going in a downtrend, and therefore TLT is going down against the price of gold. But look at the speed of it. If the market really expected inflation to heat up, I suggest that we would be going down towards the 2011 lows at the speed of light. We are not. It is basically what it's saying is that the market at the moment prefers gold to TLT, but that could be also a sign of funding pressure. What we really need to do is have a look at commodities and gold and bonds and see if the market is really flashing, any kind of inflation is coming. So here we have a chart of SPY over gold. Here we have SPY over DBC commodities, and here we have TLT over DBC, the commodities. Right, so you'd expect if there was inflation coming that gold would be trying to make new highs against SPY, and in fact it's the other way around. It's SPY making new highs against gold, or at least going in that direction. If you have a look at how far back this chart goes, this is what was happening when people were afraid of inflation. We're around 0.8, and now we are at 2.10. So really, that is saying no. SPY DBC, you would expect DBC to be making new highs against SPY. It's the other way around. We are in a tight range at the top. When people were afraid of commodity inflation, you can go back to 2009, something like that. Look where we were. We were below 3, and now we are above 25. So SPY DBC is saying definitely not. And I know some people, some skeptics are going to say, but you're not talking about TLT DBC. You're talking about all these others, but you're not showing us TLT DBC. Well, here is TLT DBC in all its glory. And people will start saying, yes, look, it's in a downtrend. TLT is going down against DBC. It is. But if you have a look at what I've been saying for months, and that is that the asset classes are at the moment SPY, followed by gold, followed by TLT because of the huge funding pressure, then this is not surprising. This is normal trading. If we have a look at where we were in SPY TLT back when people were really talking about, oh yes, QE is going to bring inflation and so on. We were below 2. We were here. And where are we now? Well, we are nowhere near it, are we? We are at 10.7. So 5 times the appreciation of TLT towards DBC. My conclusion is that if there is any inflation coming, there isn't a single chart, single yield curve, single spread that I look at which is beginning to scream to me inflation. What it is telling me is that bonds are the worst asset class at the moment because of the funding pressure in the United States. Could that exacerbate if the Democrats win? Absolutely could, but that does not spell inflation. That spells something completely different. The other thing that out there people talk about a lot is the complacency of the market. That I can disprove with these charts. The market is at the moment not being complacent at all. It might be fully priced, as I will show in a moment, but that does not mean it's complacent. I have a bunch of charts here which are not directional, but what they do is they show you the range where the market is. For example, this is SPY over 1 month vol. And when the market is complacent, it's trading up here. At the moment, it's not in a panic mode. This is where we are in a panic mode, and this is where we are when we are complacent. We are right in the middle between the two. Therefore, we are not complacent against 1 month volatility. This is not a directional chart. It doesn't give you the direction of SPY or volatility of anything. It just gives you the ratios where you have complacency and where you don't. The other thing is that you would expect is this chart would be completely different. This is volatility, 1 month volatility against 1 year volatility. We are nowhere near where we would be on lows. We are far above those lows. Therefore, the yield curve is quite steep. Therefore, people are still buying longer term volatility relative to 1 month volatility. And that to me is not an indication of a market which is in the slightest bit complacent. People are they're realizing that stocks are the fastest appreciating asset, and for good reasons. We are in very strong risk on, and they are realizing though that they could have a very bad, that we are fully priced, and that we could have a very bad reaction at any one time, and they are hedging. This is basically 1 month vol against 3 month vol. Are we at the lows that you would expect if you were complacent? No, we are right where we would be normally within, half a standard deviation. So the idea that the market is complacent and disregarding risks is absolute rubbish. What we are showing more than anything else is this. We are at 22 times forecast earnings for 2021. And it's going to be very difficult unless bonds help us, and bonds aren't really helping us, and they're unlikely to help us, to go much higher than 22. Can we get to 23? Sure. And as you know, my argument is that we will front load it, and then we will have a very bad, boring year up here. That is more likely than not to happen. I am playing the odds. The odds tell me the market is fully priced, and yet people are not complacent. And if people are not complacent and the market is fully priced, we are more likely to grind higher than have bad surprises, because when we do have bad surprises, people are hedged, and therefore they will buy the dip. And finally, let's examine this myth, and that's all I can call it, that tech is currently in a bubble. maybe some subsector of tech could be, but so what? You know, if something counts for like 2-3% of the whole tech sector, can you really talk about tech being in a bubble? Right, so this is actually XLF over XLK. We are at the same level that we have been since June this year, i.e. the difference between June and now is zero. Now, so had you bought XLF or XLK in June of this year, you would have had exactly the same return. That is, that is really not something that bubbles are made of. XLI over XLK, funnily enough, had you bought XLI over, XLI in May of this year, you would now have performed better than XLK, the sector that's in a bubble. I mean, what a load of rubbish. So, and quite considerably. I mean, here you're talking about prices at 63 and here 68. So you would have made 7-8% more by buying XLI that you would have made buying XLK. And even if you say, oh, but you're not looking at the Qs, well, here we are. The Qs against SPY, and let's see if I can enlarge that, have really done nothing for the past 6 months. They've been going up and down together with the yield curve, up and down together with the yield curve, and really nothing. There is absolutely no net change in XLI, in Qs over SPY since July. So it really, this idea that tech stocks are in a bubble is ridiculous. I mean, it's absolute rubbish. What it does show you is something completely different, and that is this. That basically the yield, let me get rid of that one, and this is it. This is the yield of 30-year bonds. Basically what it shows you is that the yield has gone from an average of around 235, where we were, has gone down to an average of around 165, and it's going to trade within 10, 15, 20 basis points up and down. So that is the huge difference. What the market is actually telling you, but it's not that tech is in a bubble, it's telling you that 30-year yields are going to be stable at much lower levels. Now that actually puts the kibosh on all these theories about inflation, that tech is in a bubble, and or that the market is complacent. The market should be higher. Bonds are permanently higher. Yields are permanently lower. If that is so, the only thing that is going to move these markets considerably to the downside is if this is not true, if bonds are not permanently lower. And at the moment, every indication is that they are. And as I keep on saying, the only thing that can kill the stock market rally is a bond market yield rally. That is where we are. We don't have inflation. The market is not complacent, and tech stocks are not in a bubble. Thank you very much. Tweet you on Monday.